This screencast is about money creation, a process that usually sounds very mysterious, so let's see if we can make it a little more clear. So when you think about money creation, you usually think about something that happens in the banking system, or maybe that involves a central bank and even governments, and usually it makes people feel a little bit suspicious or worried. But let's take a closer look, and let's start with a very simple definition of what money creation really is. So I like this basic starting definition. Money creation is really just a process by which activities in the banking system expand or contract the money supply. Understanding how that happens helps you understand big outcomes in the macro economy that relate to asset valuations or inflation, both of which are very important, or even the nominal interest rate. So let's take a closer look at what this really is and how it takes place. I think I'll start with a simple visual to sort of give you at least a flow diagram for how money creation takes place. I think most people would guess that the beginning is a central bank, which is the organization in an economy that is authorized to print money and manage the banking system. In the United States, this would be the Federal Reserve Board. In Europe, it would be the European Central Bank, etc. And we can start by saying that the central bank is going to issue some starter money, the base money, what we call the monetary base, measured by something like M0 in the US. So the central bank issues the base money that feeds the banking system and allows the public to use it for transactions, and the base money is then distributed maybe directly to the public in whole, or we could say to the public and the banking system at once. And then what happens is that banks lend money to the public and hold deposits, and people use the banks for transactions purposes, and their activities combine to do something that is important. Depending on how they interact, banks and the public will expand or contract the money supply, and starting from this beginning, they will expand the money supply. And that's sort of the basic for how it works. The central banks create the base money, and then the activities of banks and the public usually expand the money supply, can also contract it. Understanding when and why that happens is very important to understanding macroeconomics. So let's get to that. So the most basic question to ask now is, how does it all work? How does money get created by the public and the banking system? So to begin, let's take an example, just like the one I sort of depicted up here, and we're going to have a central bank, and let's say that the base money initially equals $100. And that this bank money goes to the public. And I'll assume that the public splits the money so that they keep 50 in cash. Let's say they just put it in their pockets or pocketbooks or put it under their beds. And they take the other half and they put it into a checking account. So we can think about what happens now, and to think about what happens with this $50 that goes into the banking system, we need a bank. So let's consider a bank. We'll call it Bank A to be creative. So here is Bank A, and they accept this $50. I'm putting it on the right-hand side because that checking account is a liability for them. They must provide that amount of cash or that spending power to the individual who holds the checking account at will. But now they can do something else. In the United States and most everywhere, we have fractional reserve banking, which means that the bank doesn't simply hold the $50 in an account, it can actually hold only some of it and lend out the rest to a qualified borrower. So I'm going to assume that the banks are required to, or maybe they choose to, but let's take the proportion of 20%, the percentage 20%, and say that the bank is going to hold 20% in reserves, which is $10, and that they're going to make a loan for the remaining 80%. So they now find someone else to whom they can make a loan, and that this is sort of step one in our money creation process. Now, you may not know exactly what's taken place, but why don't we just take stock for a minute and ask, how much money is there now? So let's write that down. How much money now? Well, this should be relatively easy to see. I'm going to outline them a little bit in red. We certainly have this original $50 in cash. That's certainly money, and it's money that never went into the banking system. And then whoever deposited this amount in a checking account, that's clearly money. And here's the new wrinkle. This $40 that was made in a loan, that's also money. I could have just assumed that it went back into Bank A as another checking account, but this is now either cash in someone's hand, or maybe they took it out and put it into another bank, but this is actually spendable money for someone. Over here it's an asset on the bank's account, but it's also money that someone who took out this loan can now spend. So this is money too. So that means we have $50. This is the original cash. We also have $50 that is in a checking account. That's over here, that original deposit. So I have cash and I have a checking account. And I also have this $40 that is either a cash or a checking account for someone right now. So I'll put cash or checking. It could be a different type of deposit as well. And that means, you got it, that the money supply is now equal to $140. We started with $100 of base money, but now it's fairly clear that the spending power in two checking accounts, let's say, and the cash that was originally half of the base money is now equal to $140. So the banking system, along with the public, has created $40 worth of money. Before we take stock of the broader implications, let's go at least one more round to think about how this might work. And let's just go ahead and model what happens if we take this $40 that Bank A makes in a loan and inject it back into another bank. It could be back into Bank A, but why don't we say that it goes into Bank B? So here's Bank B. And they're going to get this $40. Why don't I march it over? So there's the $40 for Bank B. As I mentioned before, I'm going to assume that this bank, either because it's required to or it chooses to, holds 20% of this deposit in reserves. So I'll put that down here. That's $8. And I'll further assume that they find someone, a person or a firm to whom they can make a loan for the remainder. That's $32. Now we can take stock again and ask the same question. How much money is there now? Well, I've certainly got all the money I had before, so it's fairly easy to see that I didn't lose anything. I have that $50 in cash I had before, that's there. I also have that original $50 checking account, the first injection into the banking system, that's there. We also have this $40, which is now a loan that was injected back into Bank B in the form of a checking account, that's my assumption. So that's 40, and we have one more. We have this $32, which again, I could have simply assumed that that went back into Bank B as a checking account, but I'll assume that it's in someone's pocket, or maybe it's in a bank C, but that's an additional amount of money, and that's $32. So now we have very clearly $172, and that's the money supply now. So we can see that the banking system has created $72 because of the fractional reserve banking system. But we might ask some more important questions. One of the questions might be, how far would this go? Well, it takes a bit of math, but it's fairly easy to see that if I stuck with these assumptions, and the assumptions are that all of this $50 goes through a process whereby it's injected into the banking system, a bank keeps 20% of it in reserves, and loans out the remaining 80%. That 80% ends up back into the banking system, we take 20% of that, etc., etc. If we continue that process, mathematics would tell us that we would get an expansion of about 5, and that would be equal to 1 over, in this case, or what we'll learn later, is the required reserve ratio. 20% is a lot higher than we'd normally see. But in the example I've used, that's 0.2, and that means that this initial injection into the banking system would be multiplied 5 times. And that would mean that we would have something like the original $50 in cash plus 5, this is the money multiplier, times the amount of base money that was injected into the banking system. And in effect, I've assumed that that reinjection rate is steady. So this means that we would have 250 plus 50, a money supply equal to $300 at the end of the day. So if I held with these assumptions, we'd have $300. We could certainly ask what would happen if we went up and had all the money injected, but that's where we'd go. But now take a further step back and ask maybe an even more important question. What happened? Did banks create money? Absolutely. We just saw how banks created money. We might wonder what that really means, but there's no doubt that banks created money, and we demonstrated that if the process continued, even more money would have been created. In fact, we know that the money supply would have expanded to be 3 times the original size of the base money. But perhaps the more important question is, did banks create assets? Here the answer is straightforward, and the answer is, of course, no. And that may be surprising because you'd think, well, they gave money to people. The money is now present in banking deposits in at least 2 other banks. Aren't those assets? Well, they could be treated as assets. You can spend that money, but think of it another way. What do you get when you get a loan? You get the amount of the loan, $40 here, $32 here, but you also get an obligation to pay it back that's of equivalent value. So you have a loan and a debt that exactly equals the value, actually plus interest. So there's been no net asset that's been created. And that's important because the creation of money does not mean the creation of assets. It really most often means the translation of assets from an illiquid form into a more liquid form, which is money. Think of it this way. Imagine that this $40 loan were actually a loan against a home. That's an asset. The bank really isn't creating any asset. It's simply saying to the borrower, you have the value equal to this amount in your home now. You can't use it. It's not very liquid. You can't go out and pay for your startup by monetizing a closet or a kitchen or a bathroom. But what you could do is take on debt to, in effect, liquefy a portion of that asset. And that's, in effect, what the bank did. When they lend, they usually lend against the ability to repay, which is bound up in some assets that could be a college degree, skill, it could actually just be collateral, or other assets that could be pledged against eventual repayment. But the key is that banks, in fact, did not create more assets, and the creation of money is not the same thing as the creation of assets. So that's it. That's how it works. This is a very simple, basic, preliminary introduction to how money creation takes place. We'll come back to it and look much more in depth about the money creation process and about how other factors play a key role.